Resurgent India Knowledge Series presents live webinar on India's corporate debt capital market landscape, recent milestones and future prospects. Moderator Mr. Ashish Agrawal, Director, Resurgent India Limited. Eminent speakers: Mr. Vikas Jain, CFO, Hinduja Leyland Finance. Mr. Paras Gupta, Fund Manager Fixed Income Investments, Pramerica Life Insurance. Mr. Gaurav Kumar Gupta, Head Treasury National Bank for Financing, Infrastructure Development, NABI FID. Mr. Nikhil Aggarwal, Founder, Grip Invest.
Good evening, friends. I would like to welcome to all of you in this webinar, which is a knowledge series of Resurgent India since last 4 or 5 years. And at Resurgent India, we are trying to basically create awareness on the new topics and the various financial areas, so that you can connect with these things and then you can take the advantage of it. So this is, I think, 170th webinar which we are organizing today, and we got great success in our endeavor since last 4 years, and many of stalwart speakers have joined us in the past and the current webinar also, and many participants have joined from the different part of the country and the global also. So as of today, we have, I think, crossed more than 5 lakh people who have joined these webinars in last 3-4 years. And more than, I think, 500 speakers have also participated actually. So this is the success of this program, and you can watch it, you can see it while sitting at home. And after the program also, you want to send it to your friends, you can send it to them also. So I would like to welcome once again to all of you for joining with us, specifically our panel speakers. Those are stalwarts, and all of the panel speakers are having very vast experience in the field, which is the today's topic, the corporate bond market, where whatever the current scenario and whatever the future which we are seeing actually. So we will discuss on this topic in detail, and our speaker will contribute about their journey and how they look for this market and what is into it for the corporates, the retail investors also. So we have a lot of things actually which are there in this program for all of us. And you see that we have heard many times, although we have also invested, I think all of us have invested some money in the corporate bond or the government bond. So like tax-free bonds, there was a wave actually earlier. Everybody was investing in tax-free bonds actually. Then zero coupon bond, and there are many names of these bonds actually, which are infra bond and the other bonds. So I hope that everybody is aware about the kind of bonds are there in the market actually, but we need to discuss whatever the latest developments are there and how you can take the benefit of it actually. So I will run through a small PPT which will help you to get more about this topic, and then we'll invite the speakers for their panel discussion. So I'll request to Devesh for starting of the PPT. So next slide. So, friends, this market, bond market, like equity market, actually, I think everybody doing now SIP. So, I hope that after some time, this bond will also be having the same kind of situation where people will invest like SIP. So, Indian bond market, they're very old in India. Actually, you see, before the loan market also. So, and this is growing every year on a year basis actually. So if you see, there are two sides of this market actually, or this bond. One is primary and the secondary. Today we will discuss more on the primary market actually. So if we see in the primary corporate bond market, which basically covers the all kind of corporate bonds, corporate in the sense the manufacturing companies, infra companies, and the financial institutions, which include banks and NBFCs. So we see that this chart actually in last 4 5 years, we were having the 7 lakh 63,000 crore of investments in 2020-21, which was a difficult year also. And now it has reached to 10 lakh crore in 2023-24. And in this financial year, in the last 5 months, we have reached to 4 lakh 75,000 crore. And we hope that as per the market reports and all, this will cross more than 11 lakh crore in this year actually. And the public market, so again, this was 10,000 crore. Now it is 20,000 crores. It has doubled actually. And although issuance are less in this year, but hopefully by the end of the year, this will cross that number of 20,000 actually. And with the segments of this bond market, actually, out of this 10 lakh crore, who are the issuers and basically what kind of investments are coming. So NBFC are having good size of the overall issuance size in the bond market. If we see out of 5 lakh crore, roughly 88,000 crore something has come from NBFC. So it is almost 20% of the money is coming from the NBFC side. They are raising actually the bond market. And if you see why the NBFCs are raising money, because we have speakers also, those are running NBFC. So the bank credit, because most of the NBFCs are even having the reliance on the bank credit actually, which is now reducing. So we see the current year number, this has reduced from 18.5% to the 8.2%. So it's a drastic reduction in the NBFC lending to banks lending to NBFC. So this is a major area which need to be discussed here. What is the strategy of the NBFC in future for raising the bond from the market actually? So if you see, there is a drop in the number of issuances, but practically this second half of the year will have this advantage that there will be more issuances also. And there is one more reason also why the people should go for the bond market, the corporates, where the government is also pushing hard actually, that the banks are getting lesser deposits due to the investments by the investors or depositors in the other instruments actually. So this is another way, and the banks are themselves going for the bond market actually. So we see in the last 5 6 months, the banks have raised almost 1.3 lakh crore of the infra bond or other bond from the bond market, which is something around 25% the overall borrowing in the bond market actually. So these are the regions basically where we see that bond market will thrive in future. Yeah, next slide. Davis, next slide. So the question is, this bond market, corporate bond market, the advantage will go to the institutional investors only, or the retail or HNI investor can take the advantage of it also. So if you see, the government, SEBI, RBI, and the other regulators are trying to make it more vibrant, like a mutual fund market. So the one major hurdle was basically the ticket size, which is now reduced to 10,000 rupees in the private placement and 1,000 rupees in the public bonds which are issuing actually. So this will add more and more investors in this bonds. The people will come forward and they will invest more and more money, even from the tier 2, tier 3 towns or the small cities also. So as per data, I think the last 2 3 years, the growth is 10 to 12%, and number of retail investors, which are something around 5 lakh, and we are expecting within 2 3 years, this will reach to 20 lakhs. So there will be threefold growth in this number because of the many things which I think we'll discuss, because we have Nikhil who is running the OBP platform. So he will guide us also that how this will happen. Challenges, I think we all are aware actually, liquidity is one of the major aspects. Many times people are hesitating to invest in the bond because of that. They don't have the equity like of liquidity. They can sell it even maybe lesser price, but this takes times actually. So this, I think OBBP is also helping us, and the government is also planning to some regulation on that. Then the lack of awareness and education, definitely this will increase also. And most of the investors are used to invest in the fixed deposits, so this is another reason that the market is not so big. Then the supply constraint also, uh, which is now I think easing up. And you see that the public issuances are very less actually, because of maybe compliance side, the people are hesitating, the issuers are hesitating to come out with public issuances. So which needs to be included actually. It is only 2% of the overall issuances in a year actually. It should be, I think, 5 to 10%, then definitely the more participation will come. And even the investors are thinking that it's a game of the high net worth individuals, but it is not like that now. Opportunities for the investors. So they have one more more class also, one more investment class in that bonds. Returns are, if you compare, because all category of bonds are there, which are low return to high return actually. And so in comparison to FDs and other instruments, the returns are good in the bonds. And liquidity also, you can say that although this liquidity is not so huge basically, but now it is getting better and better actually. And OBBP will help to invest, click on the button, and this issue size also has been reduced actually. Issue ticket size is also reduced. Next. SEBI is also trying to simplify the compliance age, and the government has also given the direction. The finance minister, or honorable finance minister, has announced in the budget that the SEBI should work on the simplifying, easing, and reducing the cost of compliance actually. So the this will happen actually, and then I think there will be more and more investor. Niti Aayog has also been assigned the job for the recommendation on the deepening the bond market actually. So some of the measures which we already discussed, the face value and the OBBB, this thing. EVP is one of the I think great innovation where all the participants come together and then they bid on the EVP platform, which bring more transparency and the speeds also. Then the single document requirement, this GID and KID, now you are not required to do the GID KID for every instrument, every issuance. Then the bonds listed or always listed also. So if you are listed your bonds once, then you have to list all the future bonds also. And then centralized bond database, I think this in process with NSE or maybe NSDL. So this will be helpful to get all the transparent data at one place. In mutual fund, we have seen that every data we can get like this, we can get the data on the bond market also. This allowing CDS for trading for mutual fund. This is a new thing, new baby in the entire bond market. So now these credit default swaps, basically is a kind of derivative is there basically, where you can protect your lower side and upper side actually. So our speaker will discuss in detail about that actually. The Niti Aayog is running the consulting paper, I think, which will come out very soon in the market for the public views also. So they are making it compulsory that they are recommending that the whatever the interest and redemptions are there, it should be in the electronic mode only. It should not be like checks and all, which delayed the process, and some kind of I think challenges are also there. Then the green bond and green debt securities, one new word is coming because government is working on the green taxonomy also. So this will be a part of that. I think entire ecosystem where there'll be some guidelines for that also, and compliance definitely this another this thing. And then the last thing is the liquidity window facility, providing a put option to the investors, which will be a game changer, I think, where if suppose it's a 5-year bond, I want to exit in 1 year, there will be some guidelines on that also. Next slide. So credit enhancement is one of the great tool which I think NAFED is here, so they have been assigned this job actually, and there will be other institutions also. So, what is the advantage of this credit announcement? Many times people are not investing in the bonds because even the returns are high because their credit rating is not up to the requirement of the institution, which is a minimum benchmark actually. So this credit announcement, through credit announcement, maybe partial credit announcement, the other products which will be there, these basically issuers can get this advantage of it, where the municipal corporation is basically will be asked to go for the credit announcement kind of solutions, so that their bond acceptability should be high and their the cost of borrowing through bond will also be less. So NEFID, Gauravji there, he will give us the idea that how it is happening and how it will happen also. There are many advantage of this also. There's risk is less, and then you'll get the liquidity in the secondary market also, lesser borrowing cost also. Yeah, next. Outlook from our side, these are our organization views actually. I'll just run through. We are seeing that inflation is easing out, so that the shift will go on the growth and the employment, which is why the challenge in the last 2 3 years. So this will, I think, ease out the rate of interest also. Already we have got the indication from the Fed, which was a great move by the Fed, that they have reduced 50 basis point. So this will, I think, other governments will also take the lead, and they will go for the reduction in the rates, which will bring the definitely the growth in the businesses, and the more and more borrowings will be there, and more investments will be there. So, and in future also we are seeing that there will be more reductions in the rates also, and hopefully the RBI will also come out with the some kind of reduction in the repo rate, which will directly benefit to the our individual investors also, or individual basically borrowers in the loan market, but the issuers will get this advantage also. And what we see, the size of this market actually, although it looks very, very optimistic, but the CRISIL has published that report that from the 45 lakh crore of the current corporate bond market, it can go up to 65 lakh crore in 2025. But people are very bullish on that. And the another region of this also, that Bloomberg has included this India in their index. So India's government bonds actually, which will bring the lot of inflow from the international players, who investors also in the Indian market, which will ease out that the domestic money will go for the corporate bond market actually. So this is from my side, and I believe that will give you some understanding also. At Resurgent India, we are into multiple services. So we are merchant banker, and we provide all these services. So any of you are looking such kind of services, please let us know also. So thank you, friends. Taking too much time, and now I would like to invite my panel speakers who are well experienced and well knowledgeable also. We have Vikas Jain ji, then we have Gaurav Gupta ji, then we have Nikhil Agrawal ji, and we have Paras Gupta ji. So all the four panel speakers are having very good knowledge also. So I'll request to the panel speakers, starting from Vikas ji, if you can introduce yourself about your journey, and how do you think this bond market will thrive in the future actually. So over to you, Vikas ji.
So, thank you, Ashish ji. Just to have a quick introduction to the viewers. Very good afternoon. Vikas Jain, CFO for Hinduja Leyland Finance. A very quick journey. I have worked with around 5 years in PwC Mumbai office, then Bajaj Finance around 10 years, and then now last 4 and 5 years with Hinduja Leyland Finance. Hinduja Leyland Finance is a subsidiary of Ashok Leyland. We are in the vehicle finance NBFC. It's a 13-year-old entity now. And right now we are having a consolidated AUM of around 53,000 crore. Ashish ji, your question on how we see the bond market on the going forward. I mean, 2 3 quick this thing. See, if we compare our GDP from the global standpoint of view, and let's take a US, so we are the US GDP is 9 times of our GDP. Vis-a-vis the bond market, if you see, they are 20 times from our bond market. So there is a clear-cut opportunity in terms of the overall, bond market exists on a India standpoint of view, right? Second, we have significantly grown in terms of last 2-3 decades in terms of the equity as an investment category. But yes, in the bond market, we from across all the stakeholders, I will not say as a any individual thing, but if I say as a bond market or the debt market standpoint of view, we are yet to get catch up, whether it is from the investor awareness standpoint of view, customer orientation standpoint of view, whether it is from the the technology evolution standpoint of view, whether it is on the regulatory regime standpoint of view. So that the evolution is right now shaping very well, and we are looking forward on that particular journey. Third, I mean, the way today the SME and MSME is getting picked up, I think the corporate India or the SME, MSME space definitely need a support outside the bank, outside the traditional, borrowing profiles, and that is what it stands for, this thing. So I think with these three conclusions, we can fairly assume that bond market and in India really looks very, very optimistic on a industry standpoint of view.
Thank you, Vikasji. Thank you so much. So now I will request to Gauravji, if you can introduce yourself and then with, your views on the bond market from the government standpoint of view, because you are representing NAFED here. So Gauravji, thank you and welcome to you also.
Thank you, Ashish. Good afternoon, Ashishji, fellow panelists, and all those who have joined this webinar. I'm Gaurav Gupta. I'm heading Treasury at NAFED, and I have been in banking career since 2007. I started my career with Corporation Bank, then Union Bank, and now with NAFED for last almost 1 year. Now, NAFED is the fifth AIFI, All India Financial Institution, post NHB, SIDB, Exim Bank, and NABARD. So we were established through an act called NAFED Act in 2021. But officially, we started our operations in December 2022, wherein we disbursed our first loan. So technically, we are hardly 1.5 year old, or probably maybe the largest, startup in India at this point of time. So we are an organization which is in the making. But yes, I think considering the large plans or maybe the importance of infrastructure sector which this government has taken, they took a view that this is the right time to have a DFI in this space, probably after we had IDFC or ICICIs of the world. And we expect that NAFED is going to play a huge role going ahead, at least in the infrastructure lending per se. Now, as far as NAFED is concerned, we have twin roles actually. Basically, infrastructure lending is one of the roles, and the other role is the developmental role which we have been given. It's to create an ecosystem. It's not that direct infrastructure lending is the only goal. Not to create an ecosystem which is conducive for infrastructure lending. Now, it can be in the form of development of corporate bond market, or it can be in the form of derivative market also. Now, to give you a sense, today when we issue a bond, let us say 10-year or 20-year bond, recently NAFED issued a 20-year bond some 1 month back. Now, if I want to hedge my bond and I want to access the derivative market, I don't have a derivative today to hedge my position. Bloomberg does not publish yield curve beyond 5 years, maybe up to 10 years, but nothing beyond 10 years, and there is hardly any liquidity in that curve. So our role is to, in some way, probably play a role of catalyst, to improve the liquidity in derivative market at the long end, as well as to develop the corporate bond market by playing some role maybe in the form of PC, which probably I will discuss later on. But these are the roles which NAFID has been interested upon, and we intend to do that. So that's how I will introduce myself. And as far as corporate bond market is concerned, I think with the I think after last 15 or 20 years, maybe we are seeing G-Sec yields at these levels. I think probably when we used to have HTM at 24, 25% or something, when I used to trade in 2007 or 2008, we used to trade 10-year bond at around 10 or 20 basis spread over repo rate. Today, those times have come back. And thanks to huge institutions which have been built up over a period of time, like pension fund, insurance companies, and now with the introduction of your bond index. So I think times are good. These are very happy times and good times for the issuers, at least for people like us, because at the end of the day, everything is priced off the sovereign yield curve. So I think good times for the corporate bond market. The only thing is, lot has been done in corporate bond market from the issuers. I mean, from the regulator perspective, a lot is left, and there is a lot of role for institutions like NAFID to play. Thank you.
Thank you, Gauravji. Thank you for giving that. The government is saying that you are the startup, then definitely everybody is the startup in India, actually. Thank you, sir. Thank you. And it's a startup which has done 1 lakh crore of commitment in 1.5 years, actually. Thank you. Great growth, actually. So, now I'll invite Nikhil Agrawal. Nikhilji, first of all, thank you very much for joining with us. And we'd like to request you to please introduce yourself, and from the retail bond market point of view, what are your views actually that will be helpful to our audience? Over to you, sir.
Sure. Thank you so much, Ashish, and pleasure to be here, especially with such an illustrious panel. Just to introduce myself, I'm a founder and CEO of a company called Grip Invest. As Ashish mentioned, we are an OBPP, which in simple language means that we are a brokerage firm, online brokerage firm for selling bonds. The idea behind creation of the OBPP by SEBI 2 years ago was to enable anyone, any retail investor, to access the same bonds that an institution can and have all the comfort, transparency, security of buying these bonds. So we're a platform that enables this. It's been a very interesting journey, especially in the last 2 years since the OBPP regulation happened. The market has grown nearly 600% annually. And today we account for about 16%, GRIP accounts for about 16% of all retail trades that happen in the OBPP market. My own introduction, unlike many of the panelists, I have less experience in financial services, but I think that's what allows me to maybe look more from a user perspective and try to do things differently. I started my career in investment banking with Morgan Stanley. I spent 6 years predominantly covering tech landscape, working with companies like Flipkart, Paytm, Snapdeal, when they were very early in their journey. I then, the entrepreneurial bug bit me. So I started a company called Chalo in 2016, which is today India's largest operator of city buses. If you're listening to this webinar in Bombay, you've probably taken a ride on a Chalo bus. You bought a ticket from us. But we do about 1 billion passenger trips across 30 cities in India. And Chalo recently opened operations outside the country as well. In 2019, I got a very interesting opportunity to move to the World Bank as a policy consultant for transportation and electric vehicles. Idea was to bring private sector experience into government policy making. And with a $5 billion budget and a 10-year decade view on how to shape policy, it was an interesting opportunity. After 2.5 years, wanted to start again, and that's when GRIP happened. So like I said, not a typical financial services career graph, but it's allowed me to connect a few dots into what we're building at GRIP. I've already talked about what our business is, but to answer your question, I think the 10K bond or the 10,000 rupee face value bond which SEBI has now introduced is a game changer. And we'll talk about a little bit more during the session, but it has significantly expanded the objectives we have with respect to the bond market. Our first objective is that any investment product that an institutional investor can access. For example, Mr. Jain is here from Hinduja Leland Finance, which has a large treasury and invests in a lot of bonds and other products like PTCs. But how can we bring the same quality of product to a retail investor, but at really small ticket sizes? I think that's our first goal. I think our second objective is how do we make that process easy? Today, investing in a equity mutual fund or a stock is so simple. There is such high trust with respect to investing in it. How can we make it as seamless for a user to invest and to exit that investment? I think that's our second objective. And if we can achieve these two things, I think retail has the opportunity to create, if you look at the equity markets, maybe anywhere between 15 to 20% allocation of the equity markets is retail today. I think we have the ability to create a similar penetration of the bond markets for India in the next maybe 5 to 10 years. So that's the big objective that we are trying to solve.
Thank you, Nikhil. Thank you so much. I think very interesting journey which you have. And I hope that audience will get the advantage of it. So friends, now we have last but not the least, Paras ji, Paras Gupta. He is from America Life Insurance. So first of all, welcome Paras ji. And
Hello everyone.
like
Hi,
to,
Ashish.
yeah, please. Yeah, please. So we'd like to
Yeah,
your introduction and your understanding from the insurance company point of view on this bond market actually. How do you see, because insurance is still having very less penetration in India actually. So over to you.
yeah. Thanks, Ashish. Thanks for making me part of this insightful discussion. So, first, some background of mine. I have close to 10 years of experience on capital market and finance. I was part of the Edelweiss Tokyo Life Insurance uh, uh, close to 8 years post my MBA. And now I'm working in Pramerica Life. I am managing close to $1 billion fund here, debt side. Now, coming to your question on the bond market, as my fellow panelist highlighted, in India, the bond market is quite smaller in size when you compare it with the global markets. So, global markets, bond market is larger than the equity market. But in India, if you look at the equity market cap, it would be somewhere around 5 trillion. Bond market is somewhere around 2.5 trillion. So it's half of what is equity market is. So it tells you the potential that bond market is having. And out of this 2.5 trillion also, which is 2.1 lakh, 2.2 lakh crore, if you break in different categories, your government sector, central government sector would be somewhere around 110 lakh crore, and your state development loans would be around 55, 60 lakh crore, and then comes the corporate bonds, which would be around 40, 45 lakh crore. Now, I see no reason why our corporate bond market would not be growing by at least the nominal GDP for the next 5 to 10 years. Assuming our nominal GDP grows by 10, 11%, our corporate bond market will definitely grow by the same rate, and this 45 lakh crore will become 100 lakh crore by 2030. Okay, there are two themes which I find very good, which will contribute to this rise in the corporate bond market. Number one is the infrastructure sector. Government focus is there. We can see the work happening in the infrastructure, the kind of plans government is having. And second is the democratization of the retail credit that we are seeing around us. Now, every the lower person in the economic strata can also afford 20-25,000 mobile. This is this is because of the credit availability to him. Now, because the higher credit availability and higher credit dispersals, the demand for all these NBFs, all the capital for these NBFCs is going to increase. So these two themes are going to contribute significantly in this growth journey of the bond market.
Thank you, Mr. Paras. Thank you so much for giving the entire outlook of the Indian bond market actually. So friends, now I would like to invite panel speaker for the some questions which we have prepared, keeping in mind the requirement of the topic. So I would like to invite Vikasji. So Vikasji, you are running NBFC and RBI heavily coming on that they should diversify their borrowing profile in terms of the should not depend on the banking system and all. So, giving this current market scenario, how do you think the change of your borrowing profile in the future actually, and how you are thinking that this bond issuance will help you to diversify in the, and what are the challenges you are facing as an NBFC for issuing of these bonds in a big number or big amount actually. So over to you, sir.
Very pertinent and the right now the industry as a NBFC and the RBI, which is monitoring the overall banking liquidity standpoint of view, or let us say the overall the money standpoint of view. And you are right, right from the RBI clamp heavily on the risk weight asset, largely to cater to the unsecured lending and increase the risk weight asset, where bank's exposure to NBFC, bank need to provide additional capital. So that has made down, banks to reduce their exposure to the NBFC. But the question here is that today banks has around, let's say, 17, 18 lakh crore kind of exposure to the NBFC. Now, if banks reduces this exposure or incremental disbursement or drawdowns for the NBFC, where do they can diversify, right? Now there are avenues to diversify, but as a country we are not yet getting matured where this compensation can come from the different the avenues which stands today. Now if I talk on the bond market itself, uh, as you rightly mentioned, some of the number, and Paras has mentioned the numbers in terms of the overall bond market, or 45 lakh crore kind of corporate bond. In that 10 lakh crore, let us say the last year's corporate bond issuances has happened, where 80 to 90,000 crore kind of NBFC, has participated in that. Now, against the 80, 90,000 crore, the requirement of NBFC is pretty high, right? And when you further drill down in this 80, 90,000 crore, you will find, Ashish ji, 85% of the issuances get occupied by the AAA rated NBFCs. The reason for that is that all the larger fund houses, all the wherever the debt fund houses is coming, either regulatory SEBI has restrictions to put below AAA, they will get with the either GSEC or the AAA rated kind of environment, or it will be very low in terms of the below AAA, which means AA plus, or let's say triple B category. Now, if you see that number also around 15, 20,000 crore comes into each of the bucket size, which means between AA plus or AA minus, there was a, let's say, 18,000 crore was the last year number, right? Now, the thing is that the opportunity or the requirement is pretty high as the banks are vacating this space. Vis-a-vis the bond market is still not able to fulfill the requirement in terms of the overall for the NBFC. Now, the good thing is that the bond market is incrementally getting matured. Some of the things which you highlighted, whether the denomination or the tokenization or the SWIFT or the seamless things. Yesterday also there was one thing where SEBI is now proposing to exempting subscription to the new bond from the insider trading regulatory side, right? So some of the consultation, some of the things will definitely make mature to this for the NBFC. But as we speak, on a larger standpoint of view, NBFCs are more getting direction, nearly going into the ECB. ECB is a one route. I mean, if I can give you, till 2019 was the highest ECB of $48 billion kind of thing, which has happened as a country to us, right? And last year is again a highest number which we have touched after 19 was $51 billion kind of thing. So between the last quarter of last year and the current quarter, there is a significant progress is happening in terms of the overall ECB, wherein NBFCs are also getting participating. So those are the avenues where NBFCs are today looking in terms of diversifying their profile or the borrowing profile. But yes, there will be a tough journey. But I think the thing is it will incrementally improve the borrowing profile as an industry standpoint of view.
Thank you, Vikasji. I think you have rightly given the message to the regulator also, to the market also, that we need to improve the whatever the investments by way of easing some regulation, bringing the financial institutions, those are the not financial institutions, the investors, those are having money to invest in the bond market, to go to the lower rated NBFCs also. It's not be stick on there should be some rationalization actually. So there's a good point which you have given, and the ECB is another area which you are saying that the NBFCs are trying to go in that market also. So thank you so much for your views. Now I'd like to invite Gaurav Gupta ji from NAFED. So Gaurav ji, you have already covered in your starting introduction that this NAFED is doing a lot of things actually, and the one core thing is basically the municipal bond issuances actually. In India, you see that we have hundreds of municipal corporations, but out of that, only 4, 5, or 6 have issued only the bonds till now actually. So I think we were reading somewhere that government has also given some task to NAFED to basically issue partial guarantee for the municipal bond issuances. So how this product will help to the municipal corporations, and what are your views on that also? And the MSMEs also are thinking for bringing the bonds in the market actually, like SME listing, IPO, which is happening in a big number actually. But I'm not seeing the SME bonds actually. So how this credit announcement can help to municipal corporation and the SMEs also. So over to you, Gaurav.
Yeah, thank you, Ashish. See, one of the major step which NAFED has taken now is we are in talks with the government as well as with the regulators on development of this PCE market, partial credit enhancement. Now, PCE was into, few transactions have happened in the past, and they were initiated by IRDA and IFCL, I guess. But subsequently, no activity has happened in the PC market, basically. Now, before I get into what essentially we are doing different, what was not done earlier, let me just tell you why essentially PC is required for municipal bonds or SME. Now, for municipal corporations, if you see, there are many issues with them. Now, they are, if I look at their financials, I think around 50% of the resources for municipal corporations, they come from the grant or the transfers. Of their own resources, they have hardly 50% of their own. So they are heavily reliant upon the transfers and the grants. So and their financials, they do, majority of them do not publish their audited financials. They do not have the institutional capability to develop a bankable project. So there are many issues with the municipal corporation per se. So NAFED has been in constant touch with the regulators as well as with the other market participants. We are talking to the state governments. We are in touch with various municipal corporations on educating them how they can, manage their finances well. And in the last point, I think the credit decision which other investors take on these municipal corporations, on their standalone rating, if we see, I think majority of them have A or below rating, which is not an investable rating with many institutional investors, be it insurance companies, pension funds, or EPFOs. So with the PC, what we intend to do is that we want to make them investable. Now, this can be a FLDG, which is a first loss default guarantee, which was not the earlier case. I think the product introduced by FCL was on a pari passu basis. Whereas what we intend to do is it should be a FLDG, which will enhance their rating maybe to AA or AA+, and it becomes investable with these institutions. Now, when they access with this kind of rating, probably their cost of borrowing will come down. Now, this is what we intend to do. We have just started discussions with the government. Earlier, there were many issues with the current regulations. Now we have taken various steps with the government as well as with the regulator. I think the fee charged by the PC provider used to be very high because of certain regulations. Now we have requested the regulator to relax them. As per current norms, it seems any PC provider has to provide capital on the entire bond issuance, not on the PC amount. For example, if you are giving PC of 20 rupees for 100 rupees bond, I have to provide capital on 100 rupees rather than 20 rupees, which increases my capital cost, and in turn that increases the fee element, and the benefit which should have accrued to the issuer doesn't accrue. Now a municipal corporation which can issue a bond at 10%, and with AA, if they can issue at say 8.5 or 8%, if I start charging 1.5%, there is no there is nothing left on the table for the municipal corporation. So this is what we have taken up with the regulator, that you relax these norms, and we expect that they are taking a favorable decision out of it. And similar is the case with the SMEs. Now SMEs on their own, if they come up with a because they have a smaller, very low rating, they have very small needs. Now with this kind of compliance cost, monitoring cost, we cannot expect SMEs to come forward and and access the capital market, which is more or less ours today in today's conditions. I was speaking to one of the insurance companies, and we have taken data also. Around 97% of their AUM, they are investing in AAA or sovereign papers. So hardly 3% of their AUM today is invested in papers which are lower rated. I think Vikas has just made a point. I think industry probably has to think on these terms, that they also need to diversify their probably investment book into other assets, and to make various cases available for their investment. I think NAFID will play a very predominant role as far as PC is concerned. You are not audible.
So much.
Yeah.
Sorry, I was on mute actually, but I think very good product if it will come the market. The participants which are there currently, there will be more and more participants, and the issuers will also be more and more actually, and this will enhance the bond market also. So we are waiting, sir. I think this is something which is required in this market actually. So thank you very much for giving the perspective from your side. And NAFID will be the nodal body for that, hopefully. So then definitely you can roll out it fast also. Like you did 1 lakh crore of the commitment within 1.5 years. So this will also roll out like that only. So thank you for that, sir. So now I'll come to Nikhil. So Nikhil, as you told that you are enhancing or basically increasing the participation, your platform or the OBBP platform is helping to increase the retail participation, but still the number is very less. So what do you think that what should the other steps which should be taken? Because now you are there in the market since last 2 years, and you have seen the challenges also and opportunities also. So one question is like that, and then other is that if the one major question which is coming from the investors also, that you want to sell the shares, sell the bonds. So how much time it will take, and what are the options available actually? And what can be the other products which I think you have already covered in the initial talk, which can be sold on the OBBP platform actually. So over to you, Nikhil.
Yeah. No, thank you for this. And I'll combine the first two questions, because liquidity, as you mentioned, is the number one ask from our users and from all users. In fact, if you think of all retail investment products, whether it is FD, stock exchange, stock market, or anything else, even P2P was a popular product. All of these products had the flavor of liquidity. You could exit whenever you wanted. It may have resulted in a loss, but there was no lock-in. And retail investors today really want liquidity as part of their investment proposition. if you even think about debt mutual funds, debt mutual funds are liquid today, but to the point that Vikasji was making, even most debt mutual funds are only investing in GSEC or AAA rated bonds, which means they don't give attractive returns. And the reason that they don't invest in A-rated corporate bonds is because there is no liquidity in the market. So if there was a redemption, a mutual fund cannot sell the units to meet the redemption requirements. Solving for liquidity will not only solve for participation in the bond platform through OBPPs, but it will also create more interest in debt mutual funds of a broader range. I think that's the number one ask. Today, there is no real structured way to get liquidity in the bond market. Okay, if you place an order, suppose you're a Zerodha or Grow user, you place an order on your sell order for a bond, it is almost unlikely to settle unless it is a AAA or GSEC paper. For that, some OBPPs, including GRIP, have started our own liquidity program where we offer users guaranteed buybacks on the bonds that they have purchased from us. Here also, there are certain complications in the process. It is not a seamless process to sell, but as a way of creating or seeding this market, these are some enhancements that we are offering for people. Okay, I think that the more that can be done here, and the regulator has a role to play. For example, SEBI has come out with a discussion paper on allowing issuers to do a call option, a periodic call option on bonds. I think these are the ways in which the regulator can play a role in creating more liquidity. I would love to have Gauravji also suggest some infrastructure changes that can be done to support liquidity in the market. I think that will have a big emphasis or big tailwind. I think moving to other points, I think again it's about user convenience. Even simple things like KYC today are very complicated for any user who wants to join the bond market. For example, if you have a demat account, you still have to repeat the entire KYC process as if you're opening a new demat account when you join an OBPP platform. Now, all of us hate doing KYC. It's mandatory, but we hate doing it. And we see a lot of users just drop out of the process because of KYC. If we can simplify it, say you have a demat account, you must have already submitted your KYC to CDSL, NSDL, to the regulator. You don't need to repeat KYC. This itself can have a big step in terms of adoption. And maybe the third one, which I'll cover, is actually TDS. TDS on bonds is 10%. On certain securities, it is as high as 25%. Now, for a retail investor, it pinches, right? Because unlike a stock where dividend is a small portion of your returns, in a bond, the only returns you have is interest. And if you have to pay TDS, it impacts your overall IRR. There are certain bonds like government bonds, certain other interest, even transfer of property enjoys lower TDS, right? So I think if we can lower the TDS on fixed income products to say 5%, 3%, I think that itself will become another impetus for retail investors to participate. So these are the three top things. To your last question, Ashish, I think SDIs are something that GRIP has done. SDIs are nothing but PTCs. Listed PTCs are called SDIs. I think that's a product that we have brought to market, and we have been able to prove that retail investors want to do this product. In the last 12 months, we have done nearly 250 crore of PTCs through the platform, all sold to retail investors. So there's an appetite for doing more products. I think the other product that will be interesting actually is the small and medium REIT, which again SEBI has recently put out a regulatory framework for and allowed OBPP platforms to distribute it. There are certain technical complications on how to offer it, which segment of the stock exchange it is, because it is a cash segment product, but OBPs are an RFQ segment product. So those need to be resolved. But I think that's another interesting offering on the fixed income side for OBPPs to offer.
Great, Nikhil. Thank you so much. I think you are very well covered, and your ask, which is there from the regulator and the government, we'll try to send some of the points which are very, very important to the regulator also, because we make the note of it, some white paper, and sending it to the government of every discussion which we had. This is public also. So thank you so much once again. And now I would like to invite Parasji, as an insurance. I think every panel speaker has covered something about insurance actually. So people are expecting a lot from you. So like to understand from you, what are the anticipated trends in the bond market over the next 3-5 years, which I think you have covered. But from the market size point of view or the interest rate point of view, actually. Then this Niti Aayog working on this, some recommendation on the bond market. So would you like to comment? And the last piece is that GIFT City, which is a country within the country. Will it help to have the more and more issuances from the international point of view? So over to you, Parasji.
Okay, so I'll start with my outlook on the interest rate. So
Yeah.
as you can see globally, uh, inflation has moderated significantly from the highs that it has reached in middle of 2022. So Fed, UK, Europe, China in this week. So all central banks are trying to support the economy because they are seeing the signs of growth slowing down, and therefore they think that it's time to pivot from inflation to growth. So that's the external development happening on the monetary front. In India, if we talk about, the inflation is pretty much stable at 4.5%, at 4%, and 4.5% is the projection given by the RBI for this financial year. The core inflation is less than 4% for close to 9 months. Now, core inflation less than 4% for close to 9 months, that's the lowest in its series for last 10 years. It's saying something that demand is still missing. Now, when the inflation is low and growth concerns are there, we are in fact seeing the slowdown in the passenger vehicles. There is a credit slowdown we are seeing in the economy. So there are signs where we are seeing some form of stress in the growth. So I think that we are on the cusp of the turn in the monetary cycle. Now RBI can start cutting the rates by December or Feb. The turn is going to be there. At this point of time, the best position to be in is in the long segment, the duration mutual funds or duration GSEC or bonds, if investors can buy. If they don't want to take this interest rate risk, then definitely they can go for the 3 year to 5 year private bonds, which are also providing a very good yield, for the reason you mentioned that banks are raising so much of certificate of deposits. This month only, I think they raised close to 1.35 lakh crore, which is, I think, the second highest. Last one was June month when they raised some 1.45 lakh crore. So banks are raising so much of short-term instruments, and that's why the short-term rates are still elevated. That's not going to be there for a last period of time. So we have a limited window if we don't want to take the interest rate risk and want to have the certainty of 3 year, 5 year of interest rates, then we can pretty much get them at 8.5% AAA, AA plus assets. Now, I'm an insurance guy. I won't go to A-rated papers. I will be sticking to AA plus and AAA papers. The second question you asked about how Niti Aayog can strengthen the corporate bond market. So I think our regulatory framework should focus on two very important things. One, providing liquidity, and second, enhancing the pool of the investors. So on the liquidity front, as the other panelists highlighted, the liquidity is very much concentrated to the GSEC and PSU AAA and very selected few private AAA. Beyond that, there is no liquidity. So we'll have to make sure that liquidity comes in AA plus and below rated papers, and how it can happen. Uh, if government can develop a set of the market makers or underwriters who can underwrite the AA and below rated bonds, who can quote buy and offer, which I think Grip Invest is trying to do in some other fashion. So this is how the liquidity can come in the market. Banks can be incentivized in the form they can be given capital by RBI or government. TLTRO we have seen in the past. So something on that front government can think about. There is a fund launched by SEBI. There is a corporate bond market development fund, but its scope is very much limited to mutual funds. if we can expand its scope, that would also help. Now, the second point, how Niti Aayog can make the policy which can diversify the investor pool. So, pension funds and insurance, they don't go to the credit because their regulations don't allow them. You have never seen any ULIP credit fund. Why? Because IRD is not allowing us to take such low credit rated exposure. Now, if this flexibility is provided by the government and regulators, then the demand will come and supply then automatically come. The other thing that I have seen is the slowdown in the credit mutual funds. Now, that's also in a way extinguishing a very good set of the demand of these papers from the market. Now, how can government do something which can enhance the demand of the credit mutual funds from the investor perspective? So I think the bringing back the tax benefit or doing something so that the debt taxation become at par with equity or not that atrocious like the way it is in its current session. That would be very much helpful. The third question you asked on the gift city. Now, gift city has had a very significant contribution, making India as a global finance hub. Now, gift city offers a regulatory landscape for entities to issue and trade bond in foreign currencies. IFSC facilitates the issuance of masala bond, green bonds, infra bonds for global investors. Now, companies operating in the gift city, they also enjoy the tax benefits, like there is a 10-year tax holiday on the profits for IFSC units. There is no STT. So all these incentives make bond issuance more cost effective for the foreign investors. Now, it is also helping the government and regulators in making the rupee internationalization, because in a way, rupee denominated bonds can be issued by the gift centers. Now, what more can be done to enhance the scope of the gift city and IFSC? I think the linkage of the financial centers across the world, Singapore, London, New York, financial centers, if they are linked to the gift city, then what we can expand the global set of investors for us. So that is something government can think about. And gift city also provides a very attractive platform for the growing demand of the ESG investment, because gift city provides an opportunity to lead in issuing the ESG linked bonds, because there is a very significant demand globally for this set of bonds. So this is in this direction, I think government can think something.
Great, Parasji. I think we have very well covered to the point, and all the areas which we have given to you. You have tried to cover up in a well, and it is helpful to everybody. And so, friends, I think we have already crossed the time limit because we have time limit to 5 o'clock. So now I will take one or two questions from the audience. So I think one question is there, which I'm seeing in the chat. So Mr. Anuj has asked one question. This is for Nikhil. So Nikhil ji, somebody has asked that were there any peculiar challenges you face while getting your OBP up and ready? So they would like to set up, I think, OBP platform. They want to understand from you what are the challenges which you have faced actually.
Yeah, Anuj, if you have any questions later on and you are looking into an OBP platform, please reach out to me. We were actually the first OBPP platform that went live. This was 5th October 2023, so it's been a year. And since then, about 10 other platforms have completed their registration and their integration with the stock exchanges. I think the process has got quite streamlined, and there's been incredible support from both SEBI and the stock exchange. So nothing special. In fact, if you were to do it today, you will enjoy the benefit of all those learnings that have happened, and it should not be a challenge. Please expect about maybe 5 to 6 months to complete the entire process from registration through integration.
Okay, thank you. So friends, I think now I would like to close this session. So I would like to thank you to all the panel speakers for their contribution in the overall discussion. And I think everybody has spoken very transparently, and this will help to the audience at large. And this video will be available on the YouTube and the LinkedIn also. So any of you want to forward to your friends, relatives, and the your known people, I think, so that it can circulate it to all basically, so that everybody can get the advantage of it. Although 1 hour was less for this kind of program, because we have tried to cover the wholesale point of view also, retail point of view also. So I'll try to keep one program mainly for the retail point of view. And this credit announcement itself, Gauravji, is one of the large area which need to discuss in length and breadth actually. So we'll request you to give some time next time for the one session only for the credit announcement with the NFIT team, and we'll invite some municipal corporation executives also, so that they can also raise their concerns what they are facing actually. And OBPP, I think Nikhilji, you can cover up NBFC because I think this is my topic also, but I believe this also need at least 1.5 hours. Even ECB is also one of the area which can be covered with the bond also. So we'll look forward. Insurance company, I think everybody has this complaint from insurance company that they have a lot of money actually, but they are not investing in our bond and all basically. But this, I think, credit announcement will help to invest in the bonds, which are the smaller companies also, but the credit profile, but the rating is as per your wish list actually. So friends, we have discussed almost all the areas of corporate bond market, but we have just touched upon actually. So I would like to once again thank you to the all panelists, Vikas ji, Paras ji, Gaurav ji, and the Nikhil ji. And I would like to thank you to the audience also, the people who have joined us from different part of the country. And I'd like to thank you to the team, Resurgent DCM desk, Mr. Binay and Nidhi. They have worked very hard to organize this actually, because they have done the entire process for that. Actually, they've invited all of you also, and they have formed the questions also at PPT also. So Binay, thank you so much for your contribution in organizing this program. And I would like to thank the DM team, the digital marketing team of Resurgent India, for providing this digital platform to us also. So once again, thank you very much for joining with us, and let us see more programs of such kind in future actually. Thank you so much. Thank you everybody. Thank you.
Thank you.
Thanks a lot.
Thank you, everyone.
Thank you. Thank you, everyone.
Thanks a lot. Thank you.
Everybody.
Thank you.
Thank you.